always, please make sure that you have attempted this question under exam conditions before watching this recording. Let's work through the information provided. Reverie Chocolates Limited, or RCL, manufactures chocolates in their factory in Wadeville for sale to various retail outlets around the country. Alright, so we are dealing with a chocolate manufacturer. The budgeted direct costs for 2 of their products for the year ended 31 October 2020 are as follows. Alright, so let's just analyze this in a bit more detail. Firstly, these are not actual costs that you've been given, these are budgeted costs. In addition to that, you've only been given the cost for 2 of their products, for milk chocolate and for dark chocolate, not all of the products that they manufacture. And this information is for the year ended 31 October 2020. So we are looking at the financial year 1 November 2019 to 31 October 2020. All right. And this information over here has been given to you per unit. So we've been given the direct material cost per unit, which is made up of cocoa beans, sugar, and milk. Then we have the direct labor cost per unit. So you can see for both chocolates, the cost is 85 cents per unit. And we also know that it takes 0.05 hours in order to manufacture 1 unit. So, guys, if we know the number of hours that it takes to make 1 unit, and we also know the unit cost, we can work backwards to calculate the budgeted labor rate per hour. So what we do is we take the unit cost, you divide by the budgeted labor hours per unit, and that's going to give us a rate of 17 Rand per hour. All right. And some students really struggle with the logic behind that calculation. So just as a proof, if we look at this logically, if the rate is 17 Rand per hour and it takes them 0.05 hours in order to produce 1 unit, that will give us a unit cost of 85 cents. So please just make sure that you're happy with the logic behind that calculation. All right, and then we're also given the packaging cost, which is R1.50 per unit for both products. All right, guys, so what I recommend you do, especially in costing questions, is if you're given any costing information, up front identify whether the cost is fixed, variable, or semi-variable. So direct material is obviously going to be a variable cost. It will vary with the number of units produced. So the cost per unit should remain constant, but the cost in total will vary with the number of units produced. Then for labor, remember, you just need to be careful. You can't always just assume that labor is a variable cost, because if you're assuming that labor is always a variable cost, it means if production volumes decrease, then companies can just let go of their workers. And obviously with labor laws, etc., you can't just retrench or fire people and hire them whenever you want to. So it's not correct to always just assume that labor is a variable cost. However, if you are specifically told that it is direct labor, then it's safe to assume that it is a variable cost. So please make sure that you always read the information provided in the scenario very carefully to determine whether labor is a fixed or a variable cost. If it's direct labor, you can classify it as a variable cost. Then packaging is also obviously a variable cost. The cost per unit remains constant, but the cost in total will vary with the number of units produced. All right. You are then told that both products are sold in 80-gram slabs. All right, so 1 unit is equal to 80 grams. The maximum production capacity is 2 million units per annum. The manufacturing process is highly automated with substantial overheads and very little direct labor is used. All right, so we saw that above. If you look at direct labor, it takes 0.05 hours in order to make 1 unit. So you can see very little direct labor is used. We haven't yet been given any of the overhead information, but we have been told now that the overheads are substantial because the manufacturing process is highly automated. Fixed manufacturing overheads are allocated to products on the basis of machine hours. All right, so please remember, guys, if fixed manufacturing overheads are allocated to products, that means we are including fixed manufacturing overheads in the value of inventory. So is this company using variable costing or absorption costing? They are obviously using absorption costing. Okay, so just as a recap, remember with variable costing, we only include variable manufacturing costs in the value of inventory. Fixed manufacturing costs will be expensed in the period incurred. On the other hand, with absorption costing, we include both fixed and variable manufacturing costs in the value of inventory. And remember, absorption costing complies with IAS 2. All right. The budgeted fixed manufacturing overhead for the year ended 31 October 2020 is 3,823,000 Rand. All right. So again, guys, before we move on, let's just make sense of this information over here. If we need to allocate fixed manufacturing overheads to products, remember in terms of IAS 2, we calculate the allocation rate by taking the budgeted fixed overhead and we divide by normal capacity. IAS 2 tells us that when we are allocating fixed manufacturing overheads to products, that must be based on normal capacity. Okay, and in this question you have been specifically told that they allocate fixed manufacturing overheads to products on the basis of machine hours. So the normal capacity that you would use in this calculation would be machine hours. Remember, it can be units, it can be machine hours, it can be labor hours, etc. The management accountant indicated that the traditional costing system may be providing misleading information. All right, so this is obviously traditional costing over here, where we calculate a single allocation rate in order to allocate fixed manufacturing overheads to products. He recommends the use of activity-based costing instead and has gathered the following information which relates to the manufacturing of all the various products of the company. All right, so now you just need to be careful. Just above, we were given the budgeted direct costs for only two of their products, for milk chocolate and for dark chocolate. Now we've been given information over here relating to all of the various products of the company. Okay, so you can see this total overhead over here. Let's just tie this in. You can see that ties in to the budgeted fixed manufacturing overhead above. So all they've done is they've taken the budgeted fixed manufacturing overhead and broken it down into different activity areas. So we have roasting and winnowing, grinding, blending, molding, and packaging. Then you've been given the different measures. So for roasting and winnowing, we use the number of batches. For grinding, the number of kilograms of nibs processed. For blending, blending hours, and for molding and packaging, units produced. Then for each of these different activities, you've been given the yearly activity for all products, and you've also been given the budgeted annual cost. All right, so obviously this information has been provided for the purposes of activity-based costing. So if they don't use traditional costing, but instead they allocate fixed manufacturing overheads to products using activity-based costing, then all of this information over here would be relevant. And remember, guys, if we are required to perform any calculations using activity-based costing, in step 1, we always calculate the activity rate. And you can see that's going to be a very simple calculation over here, because in order to calculate the activity rate for each of the different activity areas, we just take the budgeted annual cost and we divide by the yearly activity. So for roasting and winnowing, we would take that total budgeted cost of 1,248,000 Rand. We would divide by 320 batches, and that would give us the rate per batch. Okay, so the activity rate per batch. And you can obviously perform that calculation for each of the different activity areas. Okay, but don't perform any calculations right now because we don't yet know what the required is going to ask. So just make sure that you're happy with the information provided and you make sense of the information provided. Then on the next page we have some notes, and you can see that these notes tie into the information provided on the previous page. So first in note 1 we are given more information relating to roasting and winnowing. Cocoa beans are imported from a plantation in Ghana at a cost of R37.50 per kilogram. The beans are roasted to develop the color and flavor. The roasted beans then go through a process called winnowing, where the outer shell is removed and the inner cocoa bean meat is broken down into small pieces called nibs. The cocoa beans lose 10% of their weight during the winnowing process. All right, so we have a loss over here in the production process. So obviously 100% or all of the cocoa beans will be input into the production process, but during the winnowing process, 10% of the weight is lost. So only 90% of the weight will then go through the remaining processes. All right, now it's important always to distinguish whether we are dealing with a normal loss or an abnormal loss. So please remember, guys, a normal loss is inherent to the production process. It's expected. We know that it's going to happen. It can't be avoided. So in this case over here, we are dealing with a normal loss. And the reason why we need to distinguish between normal losses and abnormal losses is because normal losses will be included in the value of inventory in terms of IAS 2. On the other hand, an abnormal loss is not inherent to the production process. An abnormal loss means that something went wrong during the production process. And as a result, we don't include abnormal losses in the value of inventory, but instead abnormal losses are expensed in the period incurred. All right, and then finally over here we are just told that the roasting and winnowing takes place in batches of 400 kilograms each. Then in note 2, we are given information relating to grinding. So the nibs are then ground into a thick, creamy paste known as chocolate liqueur. Then in note 3, we are given information relating to blending. The chocolate liqueur is blended with other ingredients to add flavor. All right, so if we go back to the direct material costs that we were given on the previous page, direct material consists of the cocoa beans. So we know obviously the cocoa beans now are imported from Ghana. They go into the production process, and during the winnowing process, there's a 10% loss in weight. Now we are told during the blending process, the chocolate liqueur is now mixed with other ingredients. So the other ingredients are obviously the sugar and milk in order to add flavor. And we are told that the blending time per 100 kilograms of nibs processed is as follows. So for milk chocolate, it takes 1 hour to blend 100 kilograms of nibs, and for dark chocolate, it takes 1.5 hours to blend 100 kilograms of nibs. Then finally, in note 4, we are given more information relating to molding and packaging. So the mixture is poured into molds, and once the chocolate has set, packaging machines then wrap the chocolates in plastic. All right, so all of the notes obviously provide us with more information which will be required if we do need to allocate overheads to products using activity-based costing. But in addition to that, the notes also give us more information so that we understand how the production process works. We are then given some information relating to other costs. So first we have sales, marketing and distribution costs, which amount to 3% of turnover. And then we have administrative costs are expected to be 2.5 million rand per annum. If expected sales volumes increase by 20%, this cost will increase to 2.82 million rand. All right, so once again, guys, please just note all of the costs that we were given on the previous page are manufacturing related costs or product costs. We were given direct material, direct labor, packaging, which we said all of those costs were variable costs, and then obviously we were also given this fixed manufacturing overhead, which is obviously a fixed cost. So those are all manufacturing related costs or product costs which will be included in the value of inventory. And specifically because this company is using absorption costing, the fixed manufacturing overhead will also be included in the value of inventory. Now we are given some other costs, and these are not manufacturing related costs, these are period costs. And we don't include period costs in the value of inventory. Once again, this is in terms of IAS 2. We never include period costs in the value of inventory, but instead these costs are just expensed in full in the period incurred. So first we have selling, marketing and distribution costs, which amount to 3% of turnover. So that's obviously going to be a variable cost because it will vary with the number of units sold. Then with the administrative costs, we need to determine whether the cost is fixed, variable or semi-variable. Now, it's obvious that we're not dealing with a fixed cost. How do I know that this is definitely not a fixed cost? Because if this was a fixed cost, when your sales volumes increase by 20%, the cost shouldn't change. The cost should always be fixed in total, 2.5 million rand, regardless of your sales volume. So this is definitely not a fixed cost because it is changing with a change in sales volumes. So either this is a variable cost or it could be a semi-variable cost. But at this point in time, we can't actually determine whether it's a variable cost or a semi-variable cost because we don't yet know what the expected sales volumes are. Remember, if it's a variable cost, the cost per unit will remain constant. So if we know what the sales volumes are, we can take the cost and divide by the sales volumes to determine if the unit cost is constant. If the cost per unit is constant, then we are dealing with a variable cost. On the other hand, if the cost per unit is not constant, we also know that the cost in total is changing, so it's not a fixed cost. So if it's not a fixed cost and it's not a variable cost, then it will be a semi-variable cost. Okay, so we know it's not fixed. We're not yet sure if it's variable because we don't know the expected sales volumes. Once we know the expected sales volumes, we can then determine if it's variable. If it's not variable, then it's going to be semi-variable. But we'll look at that in a bit more detail when we actually get to our calculations. Then you are given some other additional information. Once again, this information relates to milk chocolate and dark chocolate. So first you've been given their forecast sales. Then you've been given the budgeted sales price. You've been given budgeted production, and you've also been given opening inventory. We are then told that finished goods inventory is valued according to the first in, first out method, and RCL does not hold any inventory of direct material or work in process at the beginning or end of their financial year. Okay, so I've had a few questions on this, so please note, guys, inventory consists of three different categories. Inventory is made up of raw material or direct material, but your material. Then work in process, which means you've already started the manufacturing process, but you haven't yet completed the product. And then finished goods. So those are the three categories: raw material, work in process, and finished goods. So if you're specifically told that the company doesn't hold any inventory of direct material or work in process, it means that the only inventory we are dealing with is finished goods inventory. So they will only have finished goods inventory, and if we need to value inventory, they use the first in, first out method. Now, up until this point, we've only been given information relating to two of the products that they manufacture, milk chocolate and dark chocolate. Now you are told that RCL also manufactures white chocolate and top deck chocolate with a budgeted unit selling price of 15 Rand and 18 Rand respectively. The contribution is expected to be 6.50 Rand per unit for white chocolate and 8.50 Rand per unit for top deck chocolate. no inventory of either white chocolate or top deck chocolate is held, and forecast sales equal budgeted production levels. All right. So, sorry guys, I see here there's a typo. That should be top deck chocolate and not top desk chocolate. I will correct it in your question before I upload it onto the system for you. Okay, but let's just analyze this. You're told that they don't hold any inventory of white chocolate or top deck chocolate. So whatever they produce, they sell. Production is equal to sales. So above, where we said they only have finished goods inventory, that obviously only relates to milk chocolate and dark chocolate, because we are specifically told for white chocolate and for top deck chocolate, they don't hold any inventory. All right. White chocolate makes up 10% and milk chocolate 40% of total sales. A recent study found that the raw materials used to produce chocolate, as well as the packaging, are major environmental concerns. Cocoa is cultivated around the equator in humid climate conditions and is shipped long distances before making it into the chocolate products we produce and consume in South Africa. The chocolate industry in South Africa produces about 2.1 million tons of greenhouse gases a year, and approximately 1,000 liters of water is used to produce just one chocolate bar. During the current year, manufacturing operations were disrupted by environmental protests as a result of this study. All right, so in that paragraph, we are just given a bit of information relating to the environmental concerns surrounding the production of chocolate. Then on the next page, we are given information relating to a special order. DigiWorld Limited, or DigiWorld, would like to distribute branded chocolate gifts to their staff as Christmas presents this year. They have approached RCL to supply 15,000 units of a biscuit chocolate at 18 Rand per unit. The operations manager determined that it will take 1 month to complete the order and committed to complete the order in full during November 2019. The following information is applicable. 20 grams of biscuit per unit will be added during the blending process of milk chocolate, increasing the unit weight of the finished product to 100 grams. All right, so we know that RCL does currently produce milk chocolate, and milk chocolate is sold in 80-gram slabs. So we already said previously that 1 unit is equal to 80 grams. So what they're going to do is they're going to take that milk chocolate, and during the blending process, they're just going to add 20 grams of biscuit for each unit, and that will obviously then increase the unit weight of the finished product to 100 grams. Okay, so obviously the 80 grams plus 20 grams. RCL currently has 50 kilograms of biscuit in stock, which was purchased for 180 Rand per kilogram, and the current purchase price is 195 Rand per kilogram. The biscuit in stock has an expiration date of 31 December 2019. The increased blending time and the additional time spent on molding and packaging will cause fixed manufacturing overheads to increase by 20,000 Rand. All other fixed manufacturing overhead costs will remain unchanged. Molds for 100-gram chocolates will need to be purchased at a total cost of 19,800 Rand. The molds have a useful life of 3 years and can be sold after the order is complete for 14,800 Rand. The packaging design needs to be modified to include DigiWorld's logo. RCL has already paid their designers 10,000 Rand for this work. To complete the order on time, the operations manager will be required to work overtime. He does not qualify for overtime pay, but RCL has agreed to pay him a once-off bonus of 8,000 Rand. There will be no selling or marketing costs associated to this order, and the chocolates will be collected from the factory in Wadeville by DigiWorld on the 1st of December 2019. All right, so obviously it's clear there won't be any selling or marketing costs, but in addition to that, if DigiWorld is going to collect the chocolates from RCL's factory in Wadeville, there obviously also won't be any transport costs. You are then given information relating to a new retail division. RCL is investigating the possibility of establishing their own retail division. Under this proposal, all chocolates manufactured will be transferred to the retail division at the same price as they are currently sold externally. All right, guys, so if we go back, right at the beginning of the question, you were specifically told that they currently only manufacture chocolates, and then they sell these chocolates to various retail outlets around the country. So now, instead of selling the chocolates to various different retail outlets around the country, they are looking at establishing their own retail division. And all of the chocolates will then be transferred to the retail division at the same price as they are currently sold externally. The retail division will then add a markup of 20% before selling the chocolates. Sales are expected to grow by 6% per annum in real terms. All right, so just be careful here, guys. If sales are expected to grow by 6% per annum in real terms, that does not take inflation into account. If you were told that sales are expected to grow by 6% per annum in nominal terms, then that takes inflation into account. However, if you are given the growth rate in real terms, then that does not take inflation into account. Suitable rental premises has been found in a popular shopping centre in Sandton. Capital expenditure of 4.5 million rand is required to renovate the shop and purchase cash registers and other necessary equipment. Payment will be made on the 31st of October 2019, and the shop will be ready for occupation on the 1st of November 2019. A 3-year lease will be signed with rental of 45,000 Rand per month, increasing by 9% per annum. The decision will be re-evaluated after the initial 3-year period. Depreciation is calculated on the straight line method over 3 years. The depreciation policy is in line with the wear and tear allowance as allowed by the South African Revenue Services. Chocolates will no longer be distributed to various retail outlets around the country, and annual distribution cost savings of 150,000 Rand in year 1, 165,000 Rand in year 2, and 185,000 Rand in year 3 are expected. 2 new sales assistants will be appointed at an average annual salary of 126,000 Rand each in the first year, with a 7% annual increase thereafter. The role of store manager will be fulfilled by an existing employee currently earning 250,000 Rand per annum. Other operating costs, including water and electricity, are expected to be 480,000 Rand per annum during the first year. This initiative will be financed using debt finance at 12% interest per annum. The income tax rate is 28% and will remain unchanged during the period under consideration. The current inflation rate of 4.5% per annum is expected to continue for the next 3 years. RCL has a weighted average cost of capital of 12%, and the risk-adjusted hurdle rate for this initiative is 15%. All right, guys, so that's all of the information that we've been provided with in the scenario.